course, here we're going to be talking about the new paradigm of financial intermediation. Blockchain enables services and how they're reinventing traditional banking structures, as we know, and models for the digital age. Now, they'll be looking at alternative data sources, advanced analytics, and innovation risk assessment models. And all of that will be democratizing access to capital to form the backbone of modern financial services. So I'm going to get Marcel to come back on the stage because he is going to be moderating this lovely panel, as I say, disrupt or be disrupted. And you are going to introduce your fellow panelists. So over to you, Marcel.
Back again. I have actually a fun, did anyone read or pay attention to Elon Musk when he was asked about how to reform the education system? They said you need to have more fun. You never have to convince a kid to play more games, so if you just make education a little bit more like games, you'll probably get further ahead. So I'm kind of goofy this way. I work very hard, I study very hard, but I like to have fun. So I made a fun little video that'll come. Why don't we do it? Why don't we do the video? Can you do the video now, and then we can bring the panelists on, and I'll have them. I'll introduce them.
Farm to fork, trust and transparency with blockchain technology. Where does your food come from? Blockchain allows farmers to secure loans with transparency, funding seeds and equipment. Each step of the journey is recorded for transparency. As food moves through the supply chain, data is securely updated on the blockchain. Consumers can verify every detail from the farmer's loans to the food's journey. Blockchain ensures your food's journey is transparent, from finance to fork.
So fun little video just to lighten the mood a bit. I had a really interesting discussion that's going to be focused on how blockchain is being utilized to disrupt finance. Maybe I would just like to invite the panelists to just join the stage. Just please come up. I'd be happy to introduce you one by one, but I'd really like to get into the meat of the discussion. So please just welcome them to the stage, and then you can introduce yourselves and provide some details on your backgrounds. So thanks for making the time again. Thank you. Pleasure. Hello. And so the broader theme again is going to be how these technologies are disrupting finance in often in subtle ways. And what it's doing is it's bringing the user of capital and the provider of capital closer together. And by bringing them closer together, you're effectively removing middlemen. And we have a really lovely group of panelists. Similar to the last panel, the focus here is on execution. The focus here is actually on how we're bringing these things to life. And in each of these cases, we have scenarios where we're going from at a high level on how at a macro position it fits into the picture, at a more micro lending level, how we integrate these into the picture, and then from an infrastructure standpoint, what do we need? And we're gonna hear about all of those themes as the conversation continues. But if I could go from left to right, please introduce yourself and your background and how you're thinking about these themes.
Hi everyone, I'm Pei Ling. I'm from Singapore. I'm the co-president of Metacom, part of the MVGX group. For us in Metacom, together with our parent company MVGX, our vision is to see how we can bridge traditional finance and crypto finance. I think in this world of globalization, we're all interconnected. And to help business grow, which in turn drive economic growth, payment solutions, fintech plays an integral role in enabling this. And as new technologies emerges, and very much so at this summit, we know that Web3 blockchain technology is very much central to our discussion here. So what we want to do is to be able to enable partners and companies to be able to do businesses, to facilitate transactions anytime, anywhere, to be interoperable, whether it's fiat to fiat at a more efficient, high-speed manner, lower cost, or fiat to stable, or digital asset and digital asset. So I think at the end of the day, we want to be able to enable this so that whether it's industry players, micro, small, medium enterprises, they are empowered to operate anywhere and to be able to stay connected with their supply chain and their partners in other parts of the world. So in a nutshell, I think I will encapsulate it as that.
Hello. My name is Lina. I'm the CEO and a co-founder of CXDA Markets. CXDA Markets, we are a platform working at the cross-section between Web 2 and Web 3. We believe very much in the evolution from Web 2 to Web 3. We're focused on transforming SME finance into an investable asset class. SME finance is challenging, to say the least, and it is outside the boundaries of TradFi, traditional finance. We're very excited to work with tokenization, real-world assets, to bring this into the boundaries of finance and open liquidity and allow a lot of trading and growth into that segment. So we have a platform that really works on Web 2 and Web 3 to enable that growth.
Hi. Hi, everyone. My name is Jose. I'm the CTO and co-founder of Tongton Custody Solutions. We are a service provider based in ADGM. We provide infrastructure and additional services on top of digital assets. Quoting Natalie from the Web3 section on the own part, we are part of that equations on the institutional level, particularly for any large organizations, crypto exchanges, hedge funds, high network individuals that are looking to take a position and safeguard critical assets that range all across the Web3 ecosystem, right? So your traditional assets such as Bitcoin, Ethereum, well, traditional in the crypto industry, I guess, but also stable coins, any other derivatives that have been issued on chain. We are, or we want to be, a key component within the UA ecosystem to support any sort of organization that want to engage in the Web3 ecosystem, and not only into a custodian capacity to safeguard digital assets. I think that is just the base of the question, but also to support any sort of organization that are looking to enhance their business, exposing themselves to the crypto ecosystem, and also ensuring that their liquidity and other positions in any other assets on chain can be also executed. So.
Good afternoon. My name is Sean. I'm the CEO and founder of GreenGauge, which is a Web3 fintech. We're at the boring end of Web3, if you will. It's all relative. We do two things. We provide accounts and lending for our SME and crypto company clients. The accounts are fiat accounts, but they're crypto-friendly. We support on and off-ramping, although we don't touch crypto ourselves. And on the lending side, we facilitate loans against crypto, and we've also just announced a collaboration with Coinbase to tokenize SME private credit. On the loans against crypto, we work with family office partners. We've done over $250 million of lending. We're a UK business, and we just opened an office in the UAE, very excited, as part of Hub 71.
Yeah, we have finance ecosystem covered here. Hey, Ling, your background is very broad. You've covered everything from government in the context of digital assets to now very high-profile private sector engagements. You probably have the broadest perspective in terms of how these technologies are integrating into finance more generally. Where do you think we are in that life cycle? What do you think is needed to generate the types of disruption that have in mind? Is the disruption necessarily a bad thing? It seems that policy officials, for example, are quite anxious about the level of disruption. How do you think about this at the broadest perspective? I know you're engaged in so many different levels, so I think your perspective here would be very interesting.
Oh, thank you. Maybe I can contextualize it a bit in the Singapore context as well as the Southeast Asia region. And specifically, I think we are looking at how fintech is able to help some of these MSMEs access funding to be able to get the money they needed to operate. I think just very generally, companies, especially small enterprises, they need to have good cash flows in order to operate. They need to have access to finance so that they can grow. They also grapple with challenges, for example, because they're so small, they don't have the bargaining power to reduce cost, to borrow at a cheaper rate. And nowadays, companies have to think global. They can't just be localized, otherwise it's game over for them. So to be able to transcend geographical boundaries would be important for them. And so with this taken into consideration, and if you look at the Southeast Asia region, we have more than 70 million MSMEs, and and in terms of consumers, 8 in 10 are actually digital. And yet, out of these more than 70 million MSMEs, many of them are not empowered digitally. They don't have good access to banking services because the base cost for banks to onboard them can be quite high. And also, the digital infrastructure in some of these countries and jurisdictions are not mature yet. So there are some of these challenges that we need to overcome in order for these MSMEs to fully realize their potential, to even be able to survive in some instances. And I think there's one statistic that I've seen. Although consumer fintech is growing at tremendous speed, but SME fintech, there is $1 trillion market potential still. And so taken into consideration all of this, I think governments around the world, together with private sector, there are a few things that we need to do. One is that we need to continue to build on the digital infrastructure so that I think that's the most fundamental criteria that we need to put in place in order for these MSMEs or even just individuals in the different parts of the region of the world to be able to fully harness the benefits that technology can bring to them. Secondly is that how can we standardize some of the standards so that, whether you are regardless of where you are and what you're doing, you can go online, get connected, and start, interacting, whether it's through trade or interactions or transactions. So I think that part is also important. Then talents. Talents is also something that we need to continue to be able to attract in order to develop all these solutions. And then at the end of the day, it's also about the ecosystem, which we've been hearing throughout the entire summit here. So we need to build that ecosystem, which is linked back to the fintech opportunity here. So if I could share, like Metacomp, we see ourselves as a node in this ecosystem, and we want to play our role to be able to enable the different enterprises, businesses, to be able to transact seamlessly using blockchain technology, using stable coins, for example, so that transactions can be settled almost instantaneously, and that it's interoperable regardless of whether it's fiat to stable or whether it's from Singapore to another country, so that the businesses, if they are in Singapore, for example, they are able to reach out to the different parts of the world to be able to pay, to collect, and do businesses in a frictionless manner as possible and as low cost as possible. So I think these are some of the things. And lastly, I should add that regulations and this may sound ironic as well as we talk about disintermediation, is traditional financial institutions have roles to play as well. Because currently, if we look at Web3, given some of the high-profile incidents that we have seen in the recent years, I think there's a trust deficit in the Web3 space. So for us who are in this space, we are converts, so no questions asked. But the broader community out there still has a certain degree of skepticism. So adoption is limited for now. And yet, for whether it's regulator or financial institutions, they can help to rebuild this trust. And we do see that some of these In fact, I think banks, from our experiences, some of these traditional financial institutions, especially banks, are also converging into this area, trying to harness this technology as well as exploring some of the digital assets. And they are on different parts of the spectrum, but one thing is that they can still be part of that node of trust, because they have earned consumers and business and clients' confidence over the years. They have a strong KYC, for example. We can work with them to rebuild this trust. So it's like a cooperator relationship here. And likewise, for regulators, it's not just about having regulations to punish the bad or going after the criminals, but they can also be very enabling. If anything, for example, having a licensing regime, which Metacom is licensed in Singapore, it gives clients that confidence that this particular company meets certain standards, have safety and security safeguards in place, so on and so forth. So it builds up a certain trust. And lastly, for regulators, generally governments, they have a big role in building up digital infrastructure as well. So I think these are some of the things that are important to promote this growth. Yeah.
Let me just pull on one thread there, if I may, and then I'm going to shift the conversation a bit. In that context, so you have a network node. Do you think to get to the full future, you need a single common global regulator that will then provide at least a broader umbrella? And then we can have local regulations. Think of it like email. If I'm in Canada with email, I have to opt into solicitation. In the United States, I don't. I just get inundated with email solicitation. In UAE, it's illegal for there to be proactive solicitation, period. So you can still have local regulations, but I can send an email to my mom no matter where I am. So do you think that we need a common global regulator that can kind of guide the ship, this digital ship, toward this transformed future? Or do you think we'll end up with these local regulations that get knitted together somehow?
I think it will be a mix of both. I don't think we need a global regulator per se, but we do need a layer where it's interoperable in that sense. So each jurisdiction or region will have our specific sets of standards or regulations, like data privacy, for example. But Singapore tries to be that layer in some sense, whereby if businesses come to Singapore, we put in place a certain framework whereby if you are here, you meet our framework, chances are you would also be able to meet the regulations or the standards that are imposed by in the Europe, US, China, for example. So I think in the end, we do need a bit of localization because every jurisdiction is different. We have to take those nuances into consideration. But in order for, digital is really boundaryless, right? So there must be that interoperability there. And so there are setups that allow this. So take, for example, digital economy partnership agreements. So every country, we talk about digitalization, but we have bilateral and multilateral agreements that we sign with each other. So for example, Singapore signs with Korea, Chile, UK, some of these countries. And there's a body on top of it to drive this deeper. And part of this is really how can we ensure that, for example, data, for example, some of the rules and regulations governing digital trade can be interoperable, can be more standardized, so that when we talk about digital trade, it's more seamless in that sense. So just illustrating that, I don't think we need a regulator per se, but we can have these international partnerships or cooperations to facilitate that.
Got it. So you have the rails in place, and then the next natural question is, okay, there's a great excitement about bringing assets on chain, tokenizing real-world assets. A more natural starting point may be to bring new assets on chain, assets that may not be readily available to either broader funds or individual investors who are looking to broaden their investment portfolios. And the most natural place to start would be something close to a prime loan, like a high-quality borrower. And Sean, I think this may be your knitting in many ways. You see the world as you have all these capital providers that can't find the borrowers, and then you see the borrowers and say, well, geez, if there was only a way to coordinate, a coordination mechanism between those two, we could really get a lot done. And maybe digital banking is that coordination mechanism. Would you like to speak to that in the context of what you're seeing in the market?
Yeah, and I think that game of push and pull is something we see in markets all over the place. I'd like to maybe use stable coins as a proxy for real-world adoption of what I'm focused on, which is the SME private credit markets. And I'm going to use your phrase of them being the killer app, as digital dollars or stable coins have really been adopted by real businesses globally. If we think of the overall dollar flows daily of about 3 trillion US, so quite significant, stablecoins have a very high velocity. So we're looking at probably about 50 billion a day of turnover just for Tether alone. And adding that to other stables, that's roughly 2% of the overall dollar flows are stable now. So real businesses are using these to address issues for their own day-to-day operations, generally cross-border transfers of money where SWIFT might take extra days than settling physical or digital dollars. For the SME market that we're focused on particularly, we see that there is a gap. I think every country has figures. In the UK, it's a 22 billion sterling figure from the Bank of England. In the GCC, the World Bank put out a gap of 250 billion US of SME funding. And the banks are doing a lot to address that, and fintechs are helping. But private credit is one of the massive stories of our day as an asset class, and it's now over 2 trillion US by non-bank lenders, so private credit funds and family offices. And what we see with tokenization in this first phase is there's that big company and the small company kind of coming in the middle, with the big corporates trying to do digitized debt. So UBS, DBS, EBRD have all looked at these instruments and brought them to market. But the corporates that they're working with don't need digital. They can use the traditional rails and those work for them because they're able to access funding. It's the SMEs, and I think Lena's going to talk to this, that are really struggling to get access to that money. And the current phase of tokenization has been a bit scrappy. If we think of the real-world asset theme that you've referred to, the overall size of digitizing private credit is roughly 8 billion US. As of 2 years ago, it didn't exist. And the businesses that have adopted these rails are generally subprime borrowers. So they're probably businesses that wouldn't get to borrow from banks today. And they're using the rails because they're accessing digital native money from the crypto world that is looking for high yield, high risk. However, they've proven that the tech works, and we now have partners coming online like Coinbase and others that have balance sheet in their own right and also are regulated or perhaps have listings that have allowed real-world businesses to start looking at these types of technologies as opportunities to maybe find an additional source of credit in a more efficient way. And the efficiency gains for tokenization, for me, are just twofold, and very briefly. Obviously, stablecoins, if they're adopted, can reduce some of the settlement times and risks. You don't need an escrow agent, for example, if there's multiple actors in a lending protocol. But the real saving, I think, is what you're naming in that discovery. So if you have something that's natively digital and can be posted in an intelligent way to be interrogated by multiple balance sheet partners, in the sense of credit funds or even sovereigns or the institutional money like pensions and insurance firms, and they can see these SME loans, maybe more likely the middle market SME loans initially, that have been put together in a high standard. You could cut out middlemen in those hops between the discovery of the borrower lender between them. And that's, I think, a bigger saving, more likely than the efficiency in the middle and back office costs. But that's a long answer to your question.
And do you think, just maybe one quick follow-up, with that, all these efficiency savings do what? They bring down the borrowing cost and free up capacity for these companies to do more interesting things and compete on a broader basis. Is that a fair characterization?
I think that's definitely true. I think not only is the cost to borrow decreased, or at least in theory, and we've seen that in that 8 billion, these are businesses that are able to borrow at a lower cost than they would maybe from other sources. But it also, we hope, draws additional capital in to the system. If there's more visibility in what's available, and I think this gap isn't there for lack of people wanting to deploy. Private credit is growing every year. It's 20% CAGR almost. If that discovery happens, we can draw more money in, and ultimately SMEs are the source of productivity for the economy. So ideally that benefit is uplifting overall GDP growth.
Interesting. So Lena, I'm going to turn to you now. And I think of disruption through the back door a little bit. So people think of it through the barreling through the front door, where they think that all of a sudden you're going to have all these new technologies, banks are going to shiver, and there's going to be all this change. And typically it happens quietly. Think of the advent of Uber, the advent of Airbnb. Typically these things start small, quietly, through some back door, and then they get so big so fast where it's like, oh geez, we have to adjust. And the interesting thing with the markets that you're focused on, Lena, these are new markets to most investors. They're highly inefficient. They're very difficult to access. So if you can bring an access point through digital, banks aren't touching. If I understand well, banks aren't focused on your area of interest. So you're actually bringing a brand new market to the world. And by bringing that new market, banks will quickly realize, well, wait a minute, being a small business in some of these emerging markets, I wish they would change the name of emerging markets. If some of these, bringing these new markets to sources of capital can actually disrupt bigger companies, because now all of a sudden they have room to innovate and do more interesting things. Their negotiating power, as Pei Ling referred to, gets better. I'd love your perspective on some of these issues. You're tackling, a higher credit risk spectrum than what Sean's addressing, but I'd love to understand where you see these market trends.
Thank you. Absolutely, with pleasure. So 2024 has been called the RWA year. There's a lot of excitement. Institutional investors, high net worth individuals are adding all kinds of digital assets to their portfolios. And I think this is driving the change that's already there. So capital markets infrastructure is being transformed as we speak at a good pace. There's a lot of plumbing that is going to be there and done to receive those digital assets. Every day in the news, there is one of the big institutional investors and funds that is really launching into that market. And for us, the vision is that the value proposition has been proven for RWAs, and efficiencies on the one hand, liquidity on the other hand, and we're excited about the liquidity. Efficiencies, whether cost, streamlining the process, the trade life cycle, instant settlement and all of that, that's great. But liquidity is going to be really the big game changer here. Why? Because it will open the markets for all kinds of asset classes that weren't there. There is a lot of money. In our experience, we've been talking to funds, we've been talking to other investors, and they would like to invest in that sector, the SMEs. But that's an opaque sector. It is not on the radar. Nobody sees it. It's very high yield if you can manage the risk, and there's a lot of excitement there.
Can you give an example just for us in the audience, just to, I know you have many, and you don't have to name names, but maybe just an example of like an area of the inefficiency that you see where this
Sure.
evolution of finance can really generate the efficiency?
Absolutely. And so I think transparency is one of the biggest issues there. Today, if somebody wants to invest in an SME sort of market, you don't know who they are. You don't see those people, even if they are very strong. So really helping the SMEs meet the criteria to be fundable or to be tradable or investable, that is a lot of efficiency that can come to the market. And we're already working on that. And this is a huge market. The yield is proven, but you have to really sort of bring it into the discovery phase. So that's a lot of excitement there. And it's happening on DeFi, on some centralized exchanges like Coinbase initiatives, but it's growing, and it's a big growing sector.
Interesting. So we built the house, but we didn't really talk about the foundation. Jose, you're the foundation, my friend. Infrastructure, if folks were here for Faisal's panel, Faisal and Jose are connected through Hub 71, through Further. in Hub 71. I'm connected through Hub 71. Further ventures. My apologies. And
I'll let
so
Faisal know.
they're they're really interesting. You've started with custody, but obviously you're as CTO, as a brilliant engineer, your knowledge of infrastructure runs far broader than the narrow case of custody. How do you think about that foundational layer? How should we be building out that foundational layer? Will it be centralized, decentralized? Localized? Love your thoughts on all of these issues.
Definitely, thank you, Marcel. I think what it's important to understand, and I had a recent conversation a few days ago when people, we had a small booth at GTX, and people were asking me, well, isn't the point of a custodian, isn't the point of me giving you the assets of my organization, of myself, antagonist to the whole idea of the whole Web3? And yes, in some extent it is, right? We talk about ownership, but what people don't understand about ownership is there's different layers of ownership, right? One thing is, owning a car, but you do own a car when you buy it, but to one extent, do you know all the pieces? When the car breaks, are you able to repair it yourself? Is this a sustainable option to build all the pieces that are needed to actually repair your own car? And that's where really a custodian, the infrastructure in the digital asset ecosystem helps. Even though you have the capability to source your own, at the end of the day in the crypto industry, as the name it says, is its own cryptographic primitives, the underlying wallets that everybody uses, it doesn't mean that you have to give the control to it. Right now, and I believe, to Pai Ling's point, the regulations is still catching up. As a custodian, I need to make sure that I have all the keys, all the assets, all the services, all the infrastructure that supports the institutions. Do I think that is going to be the case? Maybe not. Maybe in the future, jurisdictions are going to be more open to the idea of distributed models, where actually there will be wallets where an institution like ourselves, we will be able to sustain part of the cryptographic capabilities. There's modern schemas that have been implemented in the ecosystem. Probably MPC is one of the most modern around, where you can distribute the capability to manage those wallets. And to the use case that we're talking about, I mean, realistically speaking, we don't see the retail market be able to, do the dance of the mnemonics, to be actually sourced and maintain their own wallets. There's infrastructure and there's markets where that will be unsustainable to expect, right? So I do think, and particularly the benefit that we have in the UAE, being able to have this autonomy and this closeness to legislation, where we can actually extend and derive how these custody models would look like, I envision that definitely will change. Maybe not today, but in the future, solutions like us will be part of the sort of backbone, but will not necessarily be the end game to the digital asset infrastructure.
Many thanks. I know I'm going to get hooked for time here, but I'm going to sneak in one question, just one. It's only fair. It's only fair. Everybody's so polite and patient. Question? Any question from the audience? Sir.
So if we localize...
Running towards you.
If we localize the problem and we look at the UAE, I mean, UAE is the most important market for us. SME lending has been a headache for years and years. Sean, you said that today, at least from the supply side, there's enough money, at least from private credit. The issue has always been in the UAE the quality of credit. There is now a credit reporting platform, but still quality of credit is a bit more complicated. Maybe you can discuss some of the things we can do on the blockchain or on DeFi to improve and make quality of credit a bit more transparent. In addition, and I don't know, maybe Lina can address what she's doing with the Dubai SMEs, which is very interesting. Now, the UAE is a bit different. The loans are in dirhams, which is pegged to the dollar, so you remove all the foreign currency exchange issues that are very important in emerging markets. However, you tend to lend to mostly a non-national population, which has its own complexities. So maybe we can discuss that. And Marcel, probably a better name for emerging markets is growth markets.
I like it.
Yeah.
I like it.
Okay.
It was invented.
We'll coin that. We'll make sure to post it on Twitter.
It was invented in the 1980s to swap out for third world.
Yes.
which was an improvement, but we've just kind of stuck with it, and there's
But
no way
today,
of
most
getting
of the
out
growth
this.
is coming from
Yeah,
emerging
yeah.
markets, so.
Very quickly on the blockchain, and then I'd love to open it up. I liken this to, we need a button. You know, where's my button? Everybody, do people really care how the car runs? Not really. They want to make sure it runs. And then what's your button? Your button is, I want to be able to hit something that then pulls data in a way that I want to see it, in a TikTok video, in a Excel spreadsheet, whatever that may be. So we have this permanency of data, and we just need to find ways to capture the audience by making it easy to consume. And I think that's where we really need to separate the engineering element of it and the user experience. People want a great user experience. And honestly, if it's hitting a button and having that data delivered in a dance video, I'll do it. Like, well, I won't be dancing, but you know, like creating the video, whatever that medium is to get people to engage with the data, great. And then the people who are really, really interested can then dig deeper and evaluate the details on the blockchain.
I'm afraid I'm going to have to stop there because we can take it offline because we have another panel and we need to be fair to them to give them time. But we know we have lots of questions. If we can have a round of applause for this panel, because another incredibly practical session, and I'm sure you'll be surrounded when you step off stage. They're just going to take a quick photo for you because we have our final panel of the stage. And we need to be fair to them because we've been super excited about that as well. But thank you so much for your time. And talking about that provision of liquidity, so important, Sean. That will never be out of fashion, so don't feel bad about that. And of course, looking at trust of traditional banks and the new market's potential. So thank you so much.